So we're talking accounting for your virtual assistant business and just businesses in general with Tiffany, Bastian. So you are in the right place. So Tiffany, as I mentioned, a lot of us are virtual assistants and we're just starting out in our businesses. And we're kind of just trying to figure out how it is that we go about running our business in the right way. How do we track expenses? How do we pay ourselves? Do we need to open a business account? Like, a lot of us have those questions that we're kind of coming up against, and we'd love to get your kind of expertise on all of that so that we're doing things the right way. So yes, take it away. And guys, use the chat to ask any questions, okay? And we'll get to them.
So I guess the first thing to say though is thank goodness, because I can't, you guys, a lot of times I get calls from people who have gone 3 years and they don't know. It's just, they're all by the seat of their pants and they're trying to figure this all out. So being proactive is amazing. You're already like one step ahead of everybody else. So I'm thinking about like virtual assistants. So let's like talk about that for a minute, what you guys do, right? So most of you probably work from home, remote locations, right? You, I'm assuming, have multiple clients and you're doing that from one, from a home office. So right there, and I'm trying to think. So this is similar to what I do because it's exactly how I operate my business. First thing, like you were mentioning, is that having a separate business account. That is like the best thing you can do, and not like for legal, just to like help yourself, right? To have everything flowing in and out of one account. I have clients who mix, and I know that maybe some people in here may have even heard of QuickBooks Self-Employment, which lets you mix. It lets you like hook up an account and say that was business, that was personal, and I just anything that lets you, that says, hey, you know what, just kind of don't really separate. I just can't even believe they came out with this. And so I kind of want a disclaimer before we talk about anything else, is that a lot of people I'm running into lately have started using that, and it's like $4.99 a month, and I can see it's charm and allure because it does track mileage. It does things that QuickBooks doesn't do, but you know what happens is that you grow and you start to need other things that we'll talk about, and then you're kind of stuck in this thing where you've been using this little tiny app that you can't really upgrade it or move it. You can't convert it to regular QuickBooks. It's just what it is. So
wait, what is this app that you're talking about?
QuickBooks Self-Employment.
Oh, QuickBooks Self-Employment. Okay.
A lot of people, I don't even know we're aware of it. I want to say like maybe it's been out like a year maybe, but I loathe it. And I should actually introduce myself. Let's do that. I am a QuickBooks Pro Advisor, an advanced Pro Advisor. So I certify with them on all their stuff. And I will be honest, I'm like, what are you doing? Why are you doing this? You're giving people just enough to like really confuse themselves now, because now you're letting things mix, and just not a good idea. Personally, I hate it. If you're going to do QuickBooks, start with just regular QuickBooks, because you'll grow into that, but then you'll be stuck in the other things. So.
For anyone who doesn't know, can you just tell us what QuickBooks is briefly?
So QuickBooks is, so there's different versions. Obviously there's that one, but there's like a desktop version that's been around for like 30, 40, I mean, forever. Everybody I think it's heard of that. But there is QuickBooks Online, which is literally like most of the apps that we use these days. I love it. I use it for all of my clients. Let's go through what it does. So you set it up. It's accounting software, essentially. It's going to track everything for you, but you can link it to your bank accounts, to your credit cards, your loans, and it can download for you. So the items don't go on your books. They go into like a purgatory where you can go through and decide, well, what is this? That was an advertising expense. What was this for? You can turn on QuickBooks Payments, which I use and love. So I can invoice my customers, which I do. And they can click on a link and they can go online through QuickBooks Payments and they can pay it. I would say much better than Stripe, Square, and others for a few reasons. One is because the fees come out separately versus out of the exact transaction, which I'm sure anyone who's used Stripe in here or anything like that has had that frustration. And ACH is free. It's free. So I just offer that option. So then you're not paying any fees, and it's running right through your QuickBooks. You're billing people out of there. You're downloading your bank transactions into there. You're in your own little like accounting ecosystem. It's beautiful. But I use that with my clients. I help them set it up. I do setups, I do cleanups, and then with my clients, I do monthly bookkeeping. I maintain it for them. But that is, it's really, I feel like something a lot of people, and I talk to a lot of different markets, like creatives and stuff. A lot of people I feel try to resist for some reason. I'm like, I don't need accounting software. I'm just going to do all in the spreadsheet, and or not at all, or keep all my receipts. And this just makes your life easier. Like, it's like anything else. Just set it up, and then once it's set up, it's like a fluid thing that you're doing, and you're organized, and you're going to thank yourself. The tax time, when you just pull profit and loss. So let me shift that into like paying yourself, right? So here's something, you know, so we'll talk about business entities, because this will kind of relate back to some of the things that you can do with QuickBooks. But sole proprietor. So you start a business today and you decide that you're going to be, I'm going to be Tiffany Bastian, whatever. I can be a business. I use my social security number, and I just keep track of what I spend for my business and what I make in my business. And I file a Schedule C on my tax return, which is nothing more than an extra schedule that replaces my W-2, because that's where I made my money. And I'm a sole proprietor. You can then decide to become an LLC, but an LLC is just, people get confused when we start talking LLC and S Corp. So LLC is just limited liability. What that's doing is giving you an extra layer of protection to say, okay, well, if somebody wants to sue you, they can really only sue you for what's in your LLC. Not if you were a sole proprietor, they could sue Tiffany Bastian and take my house and everything that had to do with me. So that's when you really want to be having a separate business account, and you really want to keep your things separate, so that that LLC has its own little bubble. This is all the stuff that belongs to the business. This is the income, and this is the assets and equipment, whatever. So a lot of people don't realize if you're an LLC, you're still really a sole proprietor when it comes to taxes. So there's two levels. There's kind of like, I guess the state level would say you're a limited liability corporation, but for taxes, you're a sole proprietor. Then there's the S corporation. So an S corporation it's still a flow-through entity, which means that it's still going to go, you're not like filing a separate return and paying taxes on it. You are filing a separate return, but the bottom number still comes over, flows through to your 1040 on your personal return. But now we have more control, because now it's a separate return. It's really separate. It's not just an LLC where we want it to act as separate, but it is separate, which means now you have to pay yourself a reasonable salary, which means that you are on payroll. And all this kind of sounds scary, but I will disclaimer you guys, I became an S corporation in 2016, the best thing I ever did. Because right now, let's just say that you're anything but an S corporation, and you pay yourself $1,000. Well, that's an owner's draw, which most of you must be familiar with. It's an owner's draw. It pays you. It goes on your balance sheet. Your business doesn't get to write it off. It's not a deduction. It doesn't change your tax liability. When you're an S corporation, you pay yourself $1,000, and the business gets to write it off. The business pays the employer portion of the taxes on it for you. So all the while, you're lowering that one number that's going to transfer over to your 1040. When that number transfers over to your 1040, it's just like when you're a sole proprietor or an LLC. However, you don't pay employment taxes on it because you're on payroll. You pay regular tax just based on all the rest of the variables in your personal return. Tax savings is amazing. People kind of always say, I kind of created like in my mind, like when I work with clients, like if you're starting to have like a $55,000 to $65,000 of revenue, you might want to start thinking about the S corporation, because then you're really going to start saving money on taxes, because really otherwise everything you make, especially for like VAs, it's not like you have equipment or inventory, overhead, manufacturing, anything. You pretty much, your service is what you're selling. You probably pay for a few apps, maybe. Your expenses aren't huge. So whatever you make is pretty much almost your bottom line, which is going to your 1040, and you're paying all that self-employment tax on it out of your own money, and not being able to deduct it from your business or anything. So, and I'm still, like I've been explaining this a lot lately. I've done a couple speaking events, and it's like I'm trying to invent like a visual, a picture that explains, because I think sometimes it's confusing, and I hope I'm doing a good job, and I want to like kind of open up if anyone has questions about it. But it really becomes its own little bubble. but it starts to give you benefits. Now, there are rules. Like, you have to take a reasonable salary because they're giving you all these tax benefits. It's the IRS. They want to make sure that you're not taking too much advantage of them, right? So you have to have a reasonable salary, meaning, everyone goes, what is that? Well, guess what? The IRS is very famous for making gray areas, and they don't really define what it is. They tell you it's a reasonable salary, but they don't really have a definition. So what a lot of people do, they go through all these court cases and kind of come up with it. But really, reasonable is like, if you made $100,000 and you paid yourself $5,000, that's not reasonable. If you made $100,000 and you paid yourself $98,000, that's also not reasonable. So it's kind of like what somebody would get paid doing what you do in the real world. And it should say real world because we're in the real world, but you know what I mean. If you're working for someone else, a good rule of thumb is like 60-40, being 60% is payroll, and you can still take distributions just like you take draws.
Okay.
They're not taxed, but they're going to go over to your 1040, and you're going to pay taxes on them only if you've taken out more than the equity in the business. So you can still do that. If you do 60-40, you're probably in a good place where you're not going to pay taxes. So that's the benefit, is you don't have to pay taxes on that money because you're not taking out more than you've already put in your business. If you do go over the equity in your business, and I say that equity in your business is nothing more than the money that you've put in, the money you've taken out, withdrawals or contributions. Like if you were to convert over, that's where you would start with your business. And like the net income of your business becomes if you're the only person in your business, that net income becomes your equity every year. So if you don't take out more than that number, you're fine. And I have not found it to be very hard to like stay in that range, but that's the tax benefit of that. But of course, they don't want you taking out too many draws because then you're totally evading taxes. So
yeah,
there are some rules, but it's really something I'm finding a lot of people I'm meeting. I'm like, wow, I get new clients and I'll be getting their books cleaned up and stuff. And then I'm like, I'm seeing them making like $8,000 quarter tax payments. I'm like, oh my gosh. I'm like, you need to like change your structure because you're literally working so hard just to make enough to cover the taxes of the money you're going to have to pay. It's like exhausting. It's not even fun anymore.
yeah.
But I mean, it all depends on the person too, and the amount and the volume and where you're going. If you're growing at that point, you really should think about it.
So you're saying when you reach about the stage where you're making $50,000-$60,000 turnover a year, that's a good time to start thinking about setting up an S corp?
Yeah.
Okay, so if for anyone who's before that stage where they're not making that much, maybe they're making 20 or 10K a month, because we're just starting out here, a lot of us. What is the best thing for us then?
So I think if you're just starting out and you're like somewhere, you're under like